Mainstream property media is telling you that the 2026 federal budget has killed the Australian property market. They are wrong. The budget killed one slice of Australian property, which is the premium metro segment. For the other 80% of the country, the budget just kicked off what I think will be the biggest yield-led growth cycle that we've seen in over a decade. Hey everyone, I'm AJ, Director of Handle Properties. We buy over $100 million of investment properties every single year, all across the country. Today, what I'll be doing is sharing my take on the budget changes and how to invest in 2026. The sub $800,000 properties in growth regions are about to run. Regional Queensland is back in the hot seat. Perth is still the dark horse in the cycle, and the investors who position correctly in 2026 are going to look like geniuses by 2030. In the next 7 minutes, I'll walk you through the data, the regions, and the exact playbook that we're going to be using with our clients. At Handle Properties, we pull live data from CoreLogic, ABS, SQM Research, Domain, and Infrastructure Australia on every single deal that we invest in. This is the optimistic companion to my last video. If you watched the $48,500 problem, you know what is happening at the top end of the market already. This video is about everything else. The 80% of the Australian property market that is about to outperform. You'll get 6 things: the bullish budget read, the case for regional Queensland, the Perth thesis, the sub 800 grand yield playbook, why driving rents matters more than ever before, and exactly when off the plan makes sense in 2026. Here's the thing that nobody's talking about or saying out loud. The 2026 federal budget didn't make Australian property unattractive. What it really did was make one specific type of property unattractive. That is the negatively geared, low yielding, capital growth dependent premium asset. The one that needs $48,000 a year of your salary just to feed it and to keep it going. What the budget did is force capital, both retail and professional, to look into assets that actually pay for themselves. That means properties with yields north of 4%, sub $800,000 price points, strong tenant demand, growth regions where the fundamentals will still work. When you compress one part of the market, capital doesn't disappear. It simply moves to the next area. And the data shows it's moving fairly quickly after the budget changes. CoreLogic's latest home value index has Perth, Brisbane, and Adelaide all outperforming Sydney and Melbourne. SQM Research has vacancy rates in those markets at multi-decade lows. Domain's yield data has investor cash flow in regional Queensland and Perth corridors at over 5%. This is not a crash. This is redistribution. And it's the best buying environment for the right investor that we've had in over a decade. Let's start with Queensland. The ABS National, State and Territory Population Release shows net interstate migration into Queensland running at over 30,000 people every year. Net loss of people for New South Wales is north of 26,000. Victoria has flipped from a net population importer to a net exporter. The last time we saw flows like this was in 2022 to 2024, right before the post-GFC. Southeast Queensland boom delivered double-digit annual growth for nearly over a decade. Look at the suburbs that are growing. Moreton Bay, Logan, Ipswich, Toowoomba, Cairns, Townsville, the Sunshine Coast. These are real growth corridors with real infrastructure, real jobs, and of course, real population pressure. The 2032 Brisbane Olympics is committing over $6 billion in venues and supporting infrastructure. Cross River Rail is another $7 billion project. Inland Rail is still up for debate through regional Queensland. Pull the Infrastructure Australia data from the 2024 to 2025 priority list. The dollars are real and they're committed. Now apply the historical parallel. From 2022 to 2027, SEQ market grew roughly 120%, while Sydney grew about 10%. That's a 12-to-1 outperformance. If the underlying drivers, population, infrastructure, and yield are this strong again, you don't need a crystal ball. You need a checklist. Now Perth. Perth is the dark horse of 2026 cycle, and most investors haven't woken up to it yet. 3 reasons. 1, the Oz, UK, US. Australia is committing approximately $368 billion over 30 years to the submarine program. Henderson in Western Australia is one of the 2 main bases that these are going to be built out of. That's a multi-decade pipeline of skilled jobs, infrastructure, and population inflow. The wage effect alone will reset Perth's median income meaningfully over the next decade. 2. Metronet, over $8 billion in transport infrastructure across Perth Metro and the corridors. This is the same playbook that Brisbane ran 15 years ago. Transport infrastructure spend lags or leads property price growth by 3 to 5 years. That means spend that's happening now will lead to outperformance in the future. And 3, the fundamentals. CoreLogic has Perth as one of the strongest performing capitals in the country. SQM Research has Perth vacancy under 1%. Domain has Perth median yields over 4%, materially higher than Sydney or Melbourne. And Perth's median price is still well below Sydney and Melbourne as well. Perth is what Brisbane was in 2018. Affordable, undersupplied, and with the structural tailwind that nobody is pricing in just yet. So here is the playbook for 2026. Buy under $800,000, target yields above 4%, apply 3 filters, all from public data. Firstly, population from ABS, regional population releases, net internal migration, positive over a 5-year window. That will solve you for that part. If the population isn't there, simply walk away. Secondly, look at income through ABS wage growth index, labor force data. Is the local wages actually increasing? Are the diversity of industries prevalent in the area? If it's a single industry town, walk away, or if jobs aren't there, it's not worth it. Then look at infrastructure. From Infrastructure Australia's priority list, the state's capital works plans, look for committed, funded, and multi-year pipelines. Again, if the projects aren't there, it's simply not worth your time. Now, putting all of this together, you'll be able to create an awesome shortlist in 2026. This is the same framework that institutional property funds would use. It's free public data. Most retail investors don't bother applying it, and that's where the edge will be for the sophisticated investors today. Here's the part most investors are going to get wrong in 2026. When the negative gearing tax shield compresses, your asset has to do more of the work. That means net rent matters more than it ever did in the past. The investors who win in this year will not be passive landlords. They will be active operators. What does that actually mean? Well, 3 things. You could add a bedroom where the floor plan permits. The right cosmetic renovation could actually push rents up by $50 or $100 a week in the right region. Or if you focus on the sub 800K asset, that is a meaningful yield uplift for anyone who's looking to conduct projects on it. And of course, you have additional benefits such as throwing on a granny flat, looking for dual income sources where you can actually take the yield from 4% to 6% or more. Many landlords leave money on the table by not reviewing rents in line with the market. It has never been more important in the past to actually do this on an annual basis. Check the competitive properties on the market and see what your property should be fetching you. The era of buy and operate has started. The era of just buy and hold is disappearing. A quick word for off the plan. This is the most controversial topic in Australian property, and I want to be honest and direct. Off the plan now has a place in 2026, whether you like it or not. And here's why. The 2026 budget preserved meaningful stamp duty concessions on new builds in several states across the country. Combined with depreciation benefits and negative gearing, lower maintenance costs, in the first decade, the cash flow profile of a new build is now structurally stronger than what an older asset looks like in a tighter market. But, and this matters, off the plan only works in 2 conditions. 1, the location has to pass all of our 3 filters, being population, income, and infrastructure. Secondly, the supply has to be fairly constrained. If you're looking to buy into an investor-saturated tower in an area where hundreds of identical units are being built, you're going to get destroyed. The rule? Well, for off the plan, only buying genuine growth corridors with limited stock. Anything else, walk away. Here's my call. Sub $800,000 properties in regional Queensland and Perth corridors that pass the 3 filters that we've talked about today will outperform premium Sydney and Melbourne by a long shot. We're talking 3 to 5 times over the next 5 years. The 2026 budget didn't kill Australian property. It just told you exactly where to look when making your next purchase. Drop a region in the comments below, and either myself or the team can give you an honest take of what the data is saying today. Subscribe, hit the bell, and you'll see the next video as well.